One of the biggest changes to CPF, besides the removal of free money from SA at 55, is the enhanced retirement sum being raised from 3 times of BRS all the way to 4 times of BRS. And this is quite a big upgrade because this means that if you are able to achieve the ERS, you will get a rather high fixed payout for the rest of your life. In the words of 1M65 Mr. Lu,
that's not bad, right? Okay, that's what I call a damn good dividend.
But wait, that's not all. If you delay till 70 years old, you will get an even higher payout. But now, the question is it really worth topping up to the ERS? In this video, we'll be comparing what you can get from CPF Life payouts versus how much you can get if you had just invested your money instead. What are the pros and cons of this method? And finally, when should you consider topping up to the ERS? Also, do join my 7,000 members Telegram chat group to discuss or ask any questions that you may have. Okay, here's how much extra payout that you will get by upgrading from FRS to ERS. So, in 2025, the FRS amount would be $213,000. By achieving this under the standard plan, you receive an estimated monthly payout of $1,730 starting from the age of 65. Meanwhile, the ERS amount for 2025 would be $420,000. And by achieving this, you will get an estimated monthly payout of $3,330. So essentially, by doubling the retirement sum, you will get to double the payout. But what's more impressive is that if you delay the payout to 70 years old, the ERS payout goes up to $4,000 a month. So if you do a simple math, 4,004 multiplied by 12 months divided by 2025's ERS amount of 426k compounded by 15 years to 70 years old, that's a yield of around 6.9% every year for the rest of your lives. And the best part, the longer you live, the more you will profit from CPF Life. Now, in order to find out whether it's worth it to upgrade from FRS to ERS or not, what we can do is compare between topping up the additional amounts into CPF Life versus using that money to invest instead, to see which will give us a higher payout. So recall that to upgrade from FRS to ERS, you can top up an additional 213k. CPF RA gives an interest of 4% for any amounts above 60k. So if the top up was done at age 55, after 10 years of magic of compounding, this amount would grow to around $315,000. But now, let's also calculate what the portfolio size would be if we were to invest the money instead. Okay, let's compound the portfolio by 10%. Hold up, while the market has given 10% return in the past, this isn't guaranteed to continue in the future. And obviously, we won't know what the future return would be unless we are hardcore. So instead, what we can do is simulate a few scenarios where we assume the market will give an average return of anywhere between 5% to 9%. And tada! Here's the result. At 65, since CPF RA only gives a 4% return, it will have the smallest portfolio size. And as expected, the higher your portfolio return, the bigger your portfolio. Now, the next step is to find out what's the payouts that we will get from each portfolio. For CPF Life, by upgrading from FRS to ERS, we will get an extra payout of $1,600. As for the investment portfolios, we will be using a 4% withdrawal rate. What? Why 4%? Why not 3% or 6.9%? So this 4% withdrawal rate is based on the famous Trinity study, where it found that if you only withdraw 4% from your portfolio every year, there's an almost 100% chance that the portfolio will never run out of money. The impressive thing about this portfolio is that it covers the periods from 1925 all the way to 1995, where the market experienced many bad events such as World War II, lost decades, huge crashes, and high inflations, and yet the 4% rule still holds. But wait, that's not all. Recently, another guy further extended this study right till 2023, and he still found that the 4% rule is still valid. And that's important because if you want to retire off your portfolio, you need to make sure that your portfolio never runs out of money. Otherwise, you will have to come back to work in your 80s liao. Quick pause. Did you know that with Moomoo Singapore's newly launched Stock Yield Enhancement program, you can now earn a return on your US stocks even without selling your stocks? So how this works is that once you enroll into the program, whenever other investors borrow your US stocks, you will earn an interest on the stocks that you lend out. All securities on loan are 100% collateralized by Moomoo Singapore, so you are fully protected on your loan stocks, and you are still entitled to your dividends as well as sell the stocks whenever you want. To join, all you need to do is open up the Moomoo Singapore app, head to Accounts, tap on More, tap on Stock Yield Program, and enroll into the program. And now, you will receive a daily automatic payments whenever your US stocks are lent out. Right now, Momo Singapore is offering some very generous promotions. You will first get to enjoy a 6.8% per annum guaranteed returns for up to 31 days on your first $60,000 invested with Momo Cash Plus. Besides that, they are also offering the new Fullerton SGD T+0 fund, where it's the first retail SGD cash fund that has enhanced intraday liquidity. Please note that Momo Cash Plus is an investment product. This is not comparable and is different from savings deposits. Principal is not guaranteed and up to 31 days of 6.8% per annum is guaranteed only during promotional period. Investment in any capital market products involves risk and the risk to lose principal. On top of that, you will be able to unlock up to 4 stock bundles of the top 5 traded US stocks worth $70 each and an Apple share worth $260, plus up to $20 cash coupon exclusive rewards when you sign up using my link. So there is $900 worth of welcome rewards in total. Holding period and buy trades applies. Besides the welcome promo, if you complete 3 successful buy trades via RSP with a minimum of $100 per trade, you will also receive $6 worth of cash coupons. This is applicable to both new and existing users. So if you are interested in taking your investments to the next level, do try out Momo Singapore. For more details of the promotions, please refer to the link promotion page in the description below. And with that being said, let's get back to the video. So when we apply this 4% rule, we see that most of the portfolios are unable to give as high of a payout as CPF Life, except for the 9% return portfolio. And that's if we start the payout at 65. If we start the payout at 70, CPF Life actually beats all the other portfolios. So it's better to top up the CPF RA then? Well, not quite, because of a few issues. One, the payouts from the standard plan are actually fixed, while the payouts from the investment portfolios will slowly go up as the portfolio gets bigger and bigger. So if we plot a chart, we can see that because the payouts from CPF Life are fixed, given enough time, the payouts from all the other portfolios will eventually be higher than the payouts from CPF Life. For example, the 7% return portfolio will exceed the start CPF payout at 65 portfolio at 67 years old, and the 5% return portfolio will exceed the CPF Life portfolio at 72 years old. So essentially, the investment portfolios are hedged against inflation, whereas CPF Life payouts are not. Here's the same chart, but this time is factoring in Singapore's long-term average inflation rate of 2.6%. And now we can see this a lot clearer. Right now, the life expectancy of Singaporeans is around 83, and this is likely to continue going up in the future due to advances in healthcare and living standards. So, assuming we live till 100 years old, the purchasing power of CPF Life payouts would have dropped to just $500, which is like, very little money. The second issue with CPF Life payouts is that the $1,600 payouts is actually much higher than the 4% interest that we are getting from CPF itself. So if you do the math, $1,600 monthly payout multiplied by 12 months divided by the $213,000 compounded by 4% for 10 years, that's a withdrawal rate of 6% in just the first year. Essentially, we are slowly drawing down on the portfolio itself until it eventually becomes zero. Whereas for the investment portfolios, we are only withdrawing 4% from the portfolio. So as long as the portfolio grows by more than 4%, it will never run out of money. What this means is that if you live long enough, you will have used up all the money from your CPF and will not have anything to pass down to your descendants. Meanwhile, if you were to invest the money instead, your descendants would suddenly turn into this rich kids when you pass away. But here's a question. If the standard plan is giving fixed payouts, why not go for the escalating plan instead, where the payout grows by 2% yearly? Can is can. But Keith from Investment Modes did an analysis on this, where he found that because the initial payouts from escalating plan is lower at the start, it will only exceed the payout from standard plan at 76 years old. So in order to benefit from the escalating plan, you will really need to eat ginseng, drink bird nest every day, and live a long life. Otherwise, if you pass away too early, you wouldn't be able to profit from the escalating plan. Plus, the escalating plan also has the same issue where it will eventually run out of money at around 85. So you also won't be able to pass down any CPF Life money to your descendants if you live long enough. Besides that, CPF Life also comes with a few other downsides. For example, the money in CPF Life is illiquid. So you will need to live a long life in order to slowly get back all your money. Sure, you can pledge your property to withdraw some money, But this comes with its own restrictions and you can only withdraw down to the basic retirement sum. Another downside is that the payouts are actually not guaranteed and can actually go down in the future. I'm quite certain this will happen given that Singapore is an aging population, more people are living longer in the future, and more CPF members are getting affluent and are achieving the retirement sums, which means there will be less money to share among the members. And the last downside, as we have seen from the latest episode, there's policy risk and anything can change. Wow, say CPF Life until so jialat. So you are saying CPF Life is bad lah? Actually, not really. It has its benefits too. One, even though the purchasing power of the payouts will slowly decline, the fact is that the payouts will still be super steady from PP. On the other hand, your portfolio will not always be so nice to give you the returns that you want. Sometimes it can go up, other times it can crash down. Later it crashed by 90%, then you'll be like, huh? So having some payouts from CPF Life is still good. And the last part is something that not everyone thinks about. As we get older, our mental capacity may deteriorate. And it may be hard to manage our money in that case. Because not everyone is like Warren Buffett Gong Gong, who can still think so sharply in his 90s, yeah? Later you press the wrong button and your stock portfolio gets wiped out, then GG liao. On the other hand, CPF Life is good since you will automatically get your money every month. Okay, here are my thoughts. Obviously, this depends on your personal situation, if you are risk averse and if you don't like volatility, and if you have the extra money, then sure, topping up to ERS may be a good idea. But personally, I'm leaning more towards investing the extra money instead of topping up to the ERS. However, I will still advocate topping up to the FRS as it can form the bond component of your portfolio and will be able to give you some steady payouts during your retirement. Though, you don't have to decide now because as Keith puts it, the advantage of CPF Life is that you can consider your decision later and contribute more to it if you need to. Anyway, that's all for this video. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.